Ksenia, what are forecasters expecting to happen, or rather, why are they expecting European equities to tank after the big gains that we've seen so far?
Right. So we've seen this tremendous rally this year. European equities have been beating MSCI World, up 13% this year. But unfortunately, forecasters don't see much reason for them to go on rallying like this. And there are many factors to this, right? So European equities have been rising because of the dovish Fed and because of optimism that the trade deal between China and the U.S. will happen. Well, today, they're retreating because there's concerns that the trade talks will fall through between the U.S. and China. There's too many bits and pieces, and earnings growth is still underwhelming in Europe in order for equities to continue rallying as strongly as they have.
Patrick, let's bring you into the conversation. Patrick Armstrong from Plurimi Wealth, of course, still with us on set in London. Do you see any reason to keep buying European equities? As Ksenia was just saying there, it doesn't seem as if the investor community in general does.
It would be a contrarian play to buy European equities. We haven't been buying anymore since early January, but it's still our biggest overweight. We love the integrated oil companies, but we actually love them less than we did in early January as well, that we're starting to sell some covered calls on these kind of companies. The French banks, we still think, have another 30–40% to go from here because they're just incredibly cheap. And earnings are deteriorating, but very, very marginally. And they're priced for a very steep recession with tons of bad debt that we don't think are there. So we're of the camp that Europe's still relatively good value, still a contrarian play. We're not moving into a recession in the Eurozone, we don't think, but growth is very meager. So we're fading the rally a little bit, not buying, but not actively selling really either.